We're joined by technical analyst Ron William for a look at what the past trading patterns mean for the months ahead. Ron is with MIG Bank. I want to just have a look at this, Ron, and just take a look at gold in a second. But, you know, where do we go from here? I mean, with gold, people have been talking about 2,000. We've got tantalizingly close to that, and then we've pulled back. Now, you think that it's a glass ceiling, the $2,000 an ounce level?
Yes, I mean, I think that there may be some upside test of $2,000, but I think it'll be a short-term event. Indeed, $2,000 exists as a formidable resistance ceiling at this stage, especially as the long-term trend reaches a very kind of extreme stage. Incidentally, one point I'll make here is the CME's recent hike of margin requirements by up to 55%, which would probably kind of squash the largest of gold bugs at this stage.
I'm looking at that, and said, what, 213% up in 5 years. I mean, that's quite something. But, you know, if we look at the chart, if we looked at it, let's say, over 6 months, I think you'd find that it's got a double top there. What does that tell you?
I mean, it does show that there's some kind of pressure on the upside. I potentially see that as a trading range for the moment. I mean, we could still see up moves, but the trading range exists between $2,000 and $1,700. The real risk is if we actually break into 1,600.
Well, 1,600 the figure?
1,600 the figure, yes.
And what happens if that... It has to be a sustained break below that, doesn't it?
Yes, I've told many people a confirmed weekly close below 1,600 would signal a kind of an avalanche decline in this mountainous rise on gold. Okay,
when we look at it, I mean, of course, we do see gold is always talked about being in tandem with the dollar and the inverse relationship that they have. So does this mean dollar positivity looking ahead?
Indeed, although both these markets have been playing out these setups in isolation, gold has already reached an extreme, and US dollar is opposite setup on the downside at historic negative sentiment and technical levels. So we've already seen the US dollar recover, the DXY, from the major lows. Yes, the dollar index. And we're seeing this, of course, relative to the euro in terms of further downside than the euro, various other major currencies and emerging market currencies.
Okay, this is the dollar index that we're looking at, but yes. What about, you know, the key cross here, which is euro dollar?
Yes. Well, euro-dollar, I've been calling a fall from grace, if you will, ever since it broke below this trading range, which caught out a lot of traders and investors.
For months we had that range, didn't we?
Yes, exactly. And there were a lot of false signals on the upside and the downside. But that told us a lot about what would happen when this range actually would break out. And certainly it did resolve to the downside, roughly 7% from last August. Despite all the various kind of positive event news that has taken place recently amongst these central banks trying to rescue Europe. Technically, I see this move actually heading down towards 130.
That's not much. You're not really sticking your neck out, are you, saying 130, are you, particularly?
I've been saying it for some time, and 130 is kind of my conservative target, right. But we could definitely see a move much lower than that, but I am watching the charts to get confirmation below 130.
Well, meanwhile, we have this background of, you know, record levels for the Swiss franc, record levels for the Singapore dollar as well, and the Aussie. But what is it telling us about those? Let's talk about the Singapore dollar to begin with.
I mean, it's showing overcrowded trades on very strong markets, Singapore dollar being one of them, and also a traditional safe haven, in addition to the Swiss franc and many others. And I think what this tells us is that the world is running out of safe places to invest their money at this moment in time, simply because the places have become overextended, and that may actually be why in a relatively kind of weak beauty contest why people go to the US dollar index.
Ron, I wanted to talk a little bit at the moment also about what we've been seeing with Japan. We saw, of course, a couple of month and a half ago thereabouts, the Bank of Japan comes in and comes to support the dollar against the Japanese yen. Now, they did that a few months before that, after, of course, what we saw, the disaster. But is the Bank of Japan now just giving up the ghost when it comes to intervention, do you think? I mean, it doesn't work.
I mean, the history teaches us over the last few weeks and months that it hasn't worked. But I'm sure, I mean, from an economic standpoint, they will do their best to hold the yen. They'll be watching the 80 level as a key psychological level just as much as every trader investor will be. I've done some just basic analysis on post-intervention moves by G7 and by Japan, and what usually happens is the market retraces back to those levels. It's a natural attractive level. But as far as yen is concerned, I'm looking for this as a long-term cyclical reversal. So we should see US dollar recover extraordinarily against the Japanese yen.
But over the long term?
Over the long term. So, I mean, it's been a late signal. It hasn't happened yet. Certainly the Japanese yen has been holding back the US dollar if we look at the dollar index chart. But I do believe yen weakness over the next few months.
Ron, thank you so much for your time. Ron William there from MIG Bank.